good morning, just a start of good afternoon to everyone. So I am Gopal Agrawal. So currently I work with HDFC and I have completed 5 years here, and I manage 4 large funds of the industry. So like HDFC Balance Advantage Fund, which I am managing for last 3 years, and now it has touched 1 lakh crores. That is the largest fund in the country. And second is HDFC Large and Mid Cap Fund, which is almost 27,000 crore. HDFC Multi Cap Fund, which is closer to 18,000 crore, and HDFC Dividend Yield Fund, which is 6,500 crore. So these 4 funds I manage, and I'll be giving you my thoughts on the market and valuations and everything. But I'll be happy to take more questions. So this you can use this time very well to clear any thoughts, or you have any questions, whatever you feel like. So that will be better actually. So I'll start by this, and this is very simple but very important for all of us to understand in equity market. So Indian economy has grown steadily over the years. If you look at in the last 40 years of Indian economy, every time there are challenges, so like you have a global financial crisis, you have oil supply risk, you have GST, demon, COVID, everything. Like today you have US fiscal deficit issue, global 3 wars are on, and many things, right? So every time in last 40 years, every time there is some concern. And despite in the last 40 years, Indian economy on an average grew by 13% compounding in nominal term in last 40 years, and BSE Sensex has given us 13.4% compounding return in last 40 years. So what we see, despite all the challenges, nominal GDP growth rate and equity market return coincides over time, and that is how you make return in the market. So 13% nominal GDP growth rate and 13.4% BSE Sensex return in last 40 years to the investor. So now as the economy size of India has reached to $4.6 trillion and it is increasing. So now our nominal GDP growth rate is moderating to between 9% to 10.5%. Okay, some year less, some year more. So going forward our return will track that. Okay, so that is why you will see some year of good return, some year of bad return, but net 9 to 10.5% should be the compounding rate of return for the investor in line with the nominal GDP growth rate. So I'll talk about economy. I'll tell you very clearly, equity market runs on 4 fundamental principles. One is called liquidity, second is interest rate, third is earnings, and fourth is earning growth. These are the 4 important parameters: earnings, earning growth, liquidity, and interest rate. For liquidity and interest rate, the very important factor for India is the oil market, oil price, because we are a net importer of oil to the tune of 80-85%, and our current account deficit and all decides on that, and that decides the liquidity and interest rate. What we are going to see in the times to come, if you see after COVID, this is the first 4-5 years of consecutively oversupplied oil market we are going to see. That is why the oil prices, despite the 3 wars which are underway, we are seeing still oil is sub $75, and we are likely to see very moderate oil prices going forward because the oil market is going to be oversupplied in the times to come. So that is there. Now I talk about the current economic scenario, which is very important for all of us to understand. So currently, Indian economy has a very mixed outlook, right? As I told you, our GDP growth rate has reached to 4.6 trillion is the size of the economy. We are now growing in the range of 9-9.5% nominal GDP growth rate term. So the growth is moderating as compared to the past when the growth was very high. Currently, we have a lot of mixed picture in the economy. The only silver line is that the central government capex and state government capex is very solid. Apart from this, most of the data are really pointing to a mediocre picture in terms of growth. So state government capex is rising by 25%, central government capex has risen by 54%. In last 5 years, what has happened, the central government capex, which was 3 lakh crore, went to 11 lakh crores. So that is why you saw in the stock market a lot of wealth was created into power, defense, right, into these road, highways, airport, all this, because of the central government capex was very solid, while state government capex is still quite strong. The real problem is that corporate capex is very weak. Corporate capex was very good in FY22 and 23. Now it has fallen. It is quite low. And why? Because of tariff. There is an uncertainty in the minds of corporate that what will happen to US growth, the GDP and everything. That is why people are holding back their investment at this point of time. Once we get clarity, so that the growth can come back. So this is really a moderate picture at this point of time. Now I'll take you through, this is very cluttered, but I want to share with you few things which is important for all of us. Now we are seeing some moderation in tax collection. The GST collection growth has come down to 6%. We are seeing like individual tax collection and corporate, which is direct tax collection, is likely to be in a single digit this year. So that is why the very high growth which we saw in the past is likely to be moderated. That is the net point I want to say. Second point is that the loan growth in the India, which used to be like 15-16% growth, it has now moderated to very low of 9.3%, but definitely it will pick up because India is a young country. So now it will be around 11 to 12% by the end of the year, because RBI is doing many things to boost the growth. So, but current data point is really quite muted. Now I'll come to the global side. The global side is that in globally what is happening very clearly, that individual and corporates are in a best of health actually, right? They have list debt, they have very good balance sheet, even individuals. So that is why the market is doing good, but all the problems are with the government, and government debt is high. Second point is that US, which had a very high growth in the last 3-4 years, because of they printed so much money after COVID, they dole out lot of freebies to the individuals. Now their debt has reached to such a level that their fiscal deficit had reached to 6.9% of GDP, which is very high. Generally, US as an economy runs below 2% fiscal deficit, right? That is why today you are seeing gold is very high. The only reason why gold is high today, because the US is running very high fiscal deficit and people are losing hope on the strength of US dollar. That is why you are seeing like gold is doing well, and till if the US fiscal deficit comes down, why the Trump is raising tariff, because he feels that by raising tariff they will collect more money, right, and it will bring down their current account deficit and their fiscal deficit. So that is the step they are taking. Whether they will be successful or not, time will tell, but reality is this. Second point is that today Chinese growth has moderated to 4.5% of GDP. China is no more a country which runs at 9 to 10% GDP growth rate, and no more they will be like gunning for more commodity led growth. They are more for robotics and very high end, so they have moved their growth from low end to high end. Today the only silver line for the world growth is Eurozone. Eurozone had gone through a very bad phase. Now their growth is reviving thanks to the tax cut and interest rate cut in Eurozone. So now they are growing at 0.6%. So which is very good. Means for a mature country, this is very good. So this is the background actually. Now if you must be thinking, if I have painted so many like very weak growth, very weak tax collection and everything, and why market is doing good. So as I told you, market is a factor of earning growth, liquidity and interest rate. So in India, what our RBI has done is to given the boost by liquidity and interest rate. So I'll go forward and then come here, right? RBI from January has injected 9.5 lakh crores rupee liquidity in the system, right? So liquidity which was running deficit in December, January, February, so it was 3 lakh crores of deficit liquidity has turned to 3.5 lakh crores of surplus liquidity. So the money which was not there for expenditure. So RBI injected 9.5 lakh crores. So that is why we have now 3.5 lakh crores of surplus liquidity in the system. Add to this, they have cut the repo rate by 100 basis point. That is why our 10-year GSEC has rallied from 7.35 to 6.25%. So there is a 110 basis point rally in the bond market. That is why if you any investor who had invested in long-term GSEC, they made 13-14% return last year. Now that story is almost done, but so now just to give you, I told you market is a function of earnings, earning growth, liquidity, interest rate. Just to give you a perspective, we had a 1013 was precise EPS for FY25. So if you divide, PE multiple is nothing but EPS divided by ROE, right? So if you take interest rate, so EPS is 1013 divided by, suppose you do 7.3. So it will be 16, 17. Now if you divide the same 1013 by 6.3, so your P will go up. You got my point? So in the marketplace, your denominator has come down by 110 basis point from 7.35 to 6.25 now. That is why the P multiple of market has gone up, and that is why you saw 12 to 14% rally in the market, right? It is all because of rate cut, that we have seen the rally in the market. So it's not a fundamental EPS driven market so far. It is the market which was driven by the rate cut, and that is how you saw this rally in the market. Apart from this, RBI has done so much thing to boost growth. Just to give you a thing, like earlier gold loan was, Sasikanta Das has really banned the gold loan, because there was so much excessive lending was happening in the market. But this governor, because of poor growth in India, has directed banks, you give 2,50,000 rupees of loan to any individual before even don't assess their loan paper. Just check the purity of gold and give 2,50,000 rupees of loan. So you imagine, right, government is very cognizant of this fact that growth has slowed down. So they are boosting the growth by giving loan as much as possible. So they have supported gold lending, agriculture lending, they are supporting MFI, they are supporting a small finance bank. So what they are saying, you just give loan as much as possible so that the growth should revive. So what has really changed is the RBI liquidity, interest rate. That is why the market is doing so good at this point of time. So the real test is now is the earning, because if the earning it doesn't revive, then this market is poised to correct again, right? So I'll just take you this very important slide on the global liquidity side, which is called dollar index. So dollar index, if you look at the chart from 1965, the Bloomberg has a history from 1965 till date. So whenever the dollar has corrected now, it has bottomed at close to 80, right? Today we are at 96, 97 or so. So dollar has corrected from 111 to 97, and if it continue to correct, the bottom is 80. So I am not saying that dollar will continue to correct, but suppose if does, because Trump wants the dollar to remain weak, so US can export more. If that happens, there is a long way to go, and that will boost the commodity prices. That is why the gold and silver is doing also very well, right? Copper is doing well. It is all because of lower dollar, and it's a funding currency, and that is why you are seeing all the prices are going up. Now I come to the earning picture, which is very important for all of us. We had a very terrible Q1, Q2 and Q3 of FY25. Last year the first 3 quarters were very bad in terms of earning. That is why you saw the market corrected from 26,700 to 21,850, right? Because there was a sharp deceleration in earning growth. But what has happened? Also, after the general election in India, results were not as per the expectation of the ruling party, right? So they also got into a freeze, right? So their capital expenditure from April to November was minus 11%, and from April to March it came as plus 5%. So it means from November onward till March the government did heavy investment into economy. That is why the Q4 results actually turned out to be better than expectation. Market expectation was 3% earning growth for Q4, but it came as 6%. So apart from RBI action of liquidity injection, rate cut, CRR cut, and then government investment into economy led to revival in the earning, and Q4 earnings were better than expectation. That is why the market bottom at 21,850 and we are at 25, we went to 25,500. So this is the main reason that earning in Q4 was better than expectation and we saw the revival in earning. Now I come to the segment side. If you see the last year, the large cap Nifty had earning growth was only 4.6%, mid cap earning was 11.6%, and small cap had a disaster year last year of 17.6% decline in earning of small cap. Because in small cap what has happened, you saw microfinance, MFI, engineering company, capital good company had a negative earning growth. That is why you saw the 17% decline in earning of small cap last year. That is why the small cap stock fell very badly last year, right? Now, if you see the mid cap is reporting, mid caps are expensive but reporting is still very strong earning. Now, that is there. Now, I will just run through on earning and how I feel next year would be. Last year we had a negative earning in oil and gas, cement, consumer, chemical and media. This year I am very sure that cement earning will recover. Then because you know, coal prices have fallen and industry is consolidating because Adani and Ultratech has acquired many smaller players. So they have to now focus on profitability. So cement sector is likely to do well. Then consumer company which had gone through the pain last year, because last year when Maharashtra election was there in October 2024, we increased the import duty on palm oil by 20%, okay, so that all the edible oil prices goes up, right? So that led to margin pressure to the FMCG company, and that is why the FMCG earning fell very badly. Now, very recently we reduced the import duty on palm oil from 20% to 10% again, and the prices also corrected in international market. So we expect the second half of consumer company will be better than the last year. So the earnings will recover. Oil and gas will be a reasonable year this year because oil marketing company will have a gala profit this year, right? So the earnings will recover. Only this year the earning of banks will moderate, because last year, as I showed you into the chart, that 10-year G-Sec rally from 7.35 to 6.25. So the bond portfolio gave you very high return. So suppose your investor invested into long-term fund, they made 14% return last year. So the banks keep lot of SLR security in their portfolio. So they also had a lot of mark-to-market gain. So this year there will be margin pressure because RBI has cut the repo rate by 100 basis points, but deposits are not coming in the bank so fast. So banks will have some margin pressure. So banks profitability this year will be moderated as compared to the last year. And this year I feel auto earning will also remain muted as compared to the last year. Tech earning will also be like muted in first half. So these will be drag on the market, while OMC, cement, consumer, telecom should report better earning as compared to the last year. Now coming to the market side, this is important for all of us. Now today our market is trading at 21 PE multiple. So the market is expensive but not very expensive. So in my personal view is that barring global financial crisis and COVID, we have not seen our 10-year G-Sec trading at 6.3 or 6.25. Our 10-year G-Sec always traded between 6.5 to 8.5%. Now we are structurally, we are reduce our interest rate, to a lower side. So our discounting of the market, P multiple of the market has gone up from the historical level. So the market should not correct by more than 4% from here on a fundamental basis. So what I would say, if your investors, if there is a correction, you should push more for investment, because I really see not big downside in the market. The upside is only a function of earning growth, because that is the key. If the earnings come, the market will have a very good upside. Now I talk about the mid cap side. So the mid cap is expensive, but mid cap premium is coming down very dramatically, right? Because in last 1 year the mid cap return was not great. That is why the mid cap premium is coming down. So the mid cap can correct, but not very heavily. What was the fear earlier? Now small cap is really very expensive at this point of time. Small cap in the last 3-4 months have rallied very significantly. Now their valuation is very high, and in the small cap company, really there is a big fear of earnings not catching up to the valuation. So I am more cautious on a small cap as a segment at this point of time as compared to Nifty or the large cap or the mid cap, because in small cap market has rallied and earnings has yet to catch up to that level. Now I come to the market side. In the market, the real challenge today is that lot of promoters and private equity funds are selling their shares in the market. I just want to sensitize to all of you. Just after COVID, what has happened in India, because of in America and Europe interest rate became zero and negative, $80 billion of foreign portfolio investment came into India from private equity and other, $80 billion. So those $80 billion money they want to take out by selling their holding in the company now. Now they want to sell. Just to give you a figure, that if the market was 8,000, market has become 25,000. So their $80 billion has become closer to $250 billion. So they will be continuously selling paper in the market. In last 1 year, promoter plus PE has sold 20 lakh crores of paper in the market. 20 lakh crore rupees they have taken from the market by selling the shares. The now is still 180 to 2 lakh crores, 200 lakh crores of paper is still to be supplied in the market. So there will be a lot of paper supply in the market, and that will keep the market, may not be at very high level. So very swift and fast rally in the market also looks very difficult, because at every level there will be a lot of paper supply is going to hit the market. So that we have to keep in mind. And today all the paper supply is coming from promoters and private equity a lot in the market. Now I come to the sectoral side. As a fund manager, if you see, the things are really very challenging to manage money. Just to give you a perspective this, so if you see this chart, what has happened, let's take the case, your auto did so well in 23 and 24, and 25 it is only 3%. Right? If you look at power, gave you 33% return, 20% this year negative. Healthcare this year negative. IT this year negative. So if you see what happened, that is why the no fund manager and nobody can give you consistent return. Now I just give you on the sector side. Today autos and private banks are cheap as compared to other thing. And staples as compared to their 10-year average is also okay, not very expensive. IT services is also okay. So the market is, especially large cap, is expensive but not very expensive. That is the message I want to give. That is why I told you Nifty on a fundamental basis, unless the tariff is very high on India, should not fall by more than 4% from here. Now I come to the capital market activity. I told you all this. Sector, I just want to share with you very clearly, next 3 to 5 years, and I am seeing for the last 6 months, that weight loss drug opportunity in pharmaceutical is going to be a very big opportunity for Indian pharmaceutical, because this drug is very new. We have just seen very strong ramp up in weight loss drug opportunity in India, and in initial 5-6 months now it has become very second fastest drug in India to touch 800 to 1000 crores of sales very fast. So this will become a $2 billion weight loss drug opportunity. So any company linked with the weight loss drug will do very well in the market, and it will also help all the like a diagnostic company, because your blood pressure should be okay and everything once you take that drug, right? So there will be a lot of diagnostic will do well, and weight loss drug is a very big opportunity for next 3 to 5 years in India. That is very clearly there. In auto, only tractor industry is doing relatively better at this point of time, but in auto only hope is that there is a 8th pay commission is coming in 2027. So people are betting that that will revive the growth in the auto sector. In the banks, the good part is that the banking sector is cheap, so they will not fall if there is an uncertainty. So it will give you more hedge. The downside is limited in banks, and if the growth revives, the banks can do very well. So risk reward on the banks are much better. So if there is any correction in banking stock, one can add banking sector fund in the portfolio. In the capital goods side, the most positive side is power transmission, where like I see very growth opportunity in the power, transformer, conductor, cable, all this sector will do very well. Consumer staple will recover, as I told you, margins will be improved. In IT sector, very clearly this sector will go through the consolidation, but the downside is limited because of very high dividend paid by this company. So, and once the rate cut cycle in US will start in second half, IT can recover from here. So this is very clearly from this. Now I'll just take you through on the value investing framework. This is very important for all of you to understand that as I told you, market is a slave of earning growth, liquidity and interest rate. So today now, as the interest rate goes down, the stock valuation goes up, because when you put money in your FD, you get suppose 7% and you pay 40% tax, so you get only 4.2%. So any company gives you more than 4.2% dividend yield on a consistent basis, no, so the stock will not fall below a price. That is why the interest rate is such an important factor in investing in Indian market actually. So net I would tell you that globally growth is also weak. India is relatively better in this phase because we have long-term potential. Oil prices have come down, liquidity has improved, interest rate is coming down. Only thing is that the growth in earnings should come back, and whenever and whoever shows you growth in this phase will trade at very high multiple. So now there is a lot of money chasing the market and very few companies are reporting good growth. So whoever reports very growth in this period, their stock multiple can go to any level which you can ever imagine in life. So this is called growth at any price. This is what this market is all about. But every product is for different investor. I would really tell you, balance advantage is more for savers and retirees. Multi-cap is for young investor, large and mid for aggressive investor, and dividend yield is for conservative equity investor. So I stop here and take questions. Thank you.